In the past 6 months, GameStop's stock has gone up over 3,600%, and there's a man who is currently up $17 million on his position, while big institutions with billions in assets under management are on the verge of literally losing everything. And if you're relatively new to the world of investing, you're probably thinking, what the hell happened here? My name is Michael Wang, and in today's video, I'll be explaining what happened with GameStop shares in layman's terms. So if you can stick around until the end of this video, you'll understand exactly what happened and what this means for the stock market. Before we get into today's video, don't forget to obliterate the like button and subscribe for more entertaining and educational content. So without further ado, let's dive right into today's video. Username DeepFuckingValue on Wallstreetbets first started updating his GameStop positions, ticker GME, about a year ago. He said that the stock's price was way below the company's valuation and bought a lot of GME shares and GME call options. In case you don't know what call options are, here's a quick 30-second crash course. An option is a contract that allows you to buy or sell a security or an asset at a specific time and a specific price. If you buy a call option, that means you're buying a contract that gives you the right to buy a certain stock at a certain price at a certain date. So if we take a look at DeepFuckingValue's latest update, this is what we see. He's holding 50,000 GME stocks that he bought at $147.98 and 800 contracts of GME call options, which will expire on April 16, 2021 with a strike price of $12. This means that he has the right to buy GME stocks at $12 when the stock is currently trading at $209 today. This Reddit user was not the only person to shed light on GME. Michael Burry is a hedge fund manager and is better known as the man who made a fortune in 2008 by calling the market top. His recent portfolio that was revealed last year included a lot of tech stock call options and, you guessed it, GameStop stocks, which covered over 5% of his portfolio. In terms of the company's fundamentals, they weren't necessarily doing too well. GameStop is a video game and electronics retailer that was being left out as e-commerce started rising. The company was operating at a loss, and so they decided to bring Ryan Cohen to its board. Ryan is the founder of Chewy, an online puppet supplies company. Chewy is known to have exceeded Amazon in the pet category industry, and with an e-commerce genius in the board, there are expectations that GameStop could maybe move their entire operations online. On January 19, 2021, Citron Research made a tweet claiming that it was short GME down to $20. It said that they understand short interest better than you and will explain the reasons why they're shorting. The stock was trading at $40 this day. In case you don't know what shorting is, here's another quick crash course. So when you want to make money, you want to buy low and sell high, right? And normally, in order for you to buy low, you need to find a company that no one else sees value in and buy low before anyone else does. Well, short selling, simply put, is when you buy low and sell high, but do it in the opposite order. So let's say that Citron Research actually did their due diligence and shorted successfully. What they would do is borrow shares from someone else who thinks that the stock is bullish and sell them at market price. What's important to note here is that Citron is borrowing one share, not cash. So when they borrow a share from someone else and sell that share at the market price of $40, they have $40 in cash and they owe one GME stock to the guy who lent it to them. Then they wait until the stock's price drops down to the target price at $20. With $40 of cash that they have, they buy one share of GME, which now costs $20. They give back the one share that they owe, and Citron is left with a profit of $20 by selling high and buying low, or otherwise known as short selling. Except this really never happened. The problem with shorting is that your potential losses are infinite. You could short sell GME at $40 thinking that it'll go down to $20. But what if it goes up to $100, $200, $1,000, $10,000? Your losses are theoretically limitless, which makes shorting so dangerous. A lot of retail investors were pissed about getting screwed over by institutions that use massive amounts of capital influence to short stocks that are perfectly fine and force prices downwards, causing real problems to a perfectly well operating company. Hence, users on Wallstreetbets collectively decided to retaliate. A lot of people on Wallstreetbets started buying huge amounts of stocks and call options. No one led the revolution. It just voluntarily began and snowballed, as more and more people started posting their GME positions on the subreddit. The saying goes, we can remain retarded for longer than they can remain solvent. With immense buy pressure, the stock doubled in 10 days, reaching $77, putting Citron Research at a huge loss. However, Citron wasn't the only firm that was short on GME. Melvin Capital is a hedge fund founded by a star hedge fund manager, Gabriel Plotkin, with $12.5 billion in assets under management. Unfortunately for them, they also had a huge short position on GME. So did Citadel in 0.72. Retail investors continue to buy GME stocks and call options aggressively as two billionaires, Chamath, Palihapitiya, and Elon Musk, joined the party. Chamath posted a tweet showing that he'd bought call options for GME, and Elon, who's very public about his hate for short sellers, also tweeted GameStop, causing the stock prices to reach $240 after the market closed. With prices reaching $240, short-selling hedge funds were in big trouble. While official reports haven't been out yet, it's anticipated that some firms like Melvin Capital have been forced into insolvency. Retail investors literally took down hedge funds that manage billions, and the best part is, the SEC is mad, but it doesn't know how to punish them. Everyone on Reddit and Twitter are excited that retail investors gave institutions not only a good beating, but completely took one or two down, and are excited to see the next stock that they have in mind. Some say that they're after other stocks that are most heavily shorted by hedge funds, but who knows? Tell me what you think in the comment section below. Do you think this is just a one-time incident that will be talked about in the years to come as well? Or is it just the beginning of a paradigm shift? If you found this video to be entertaining or educational, please don't forget to smash the like button, subscribe for more content, and I'll see you guys in the next video.